Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge funds, portfolio managers, RIAs, family offices, and individuals. Really excited to be joined today by my old partner from Silver Arrow, Raji Khabbaz. He's the portfolio manager for ArcanX. Simply one of the best stock analysts and portfolio managers I've ever known. I've been very lucky to have shared an investment brain with Raji for the last 10 years, and it's pretty rare for us to go 24 hours without talking about a stock, the markets, interest rates, or something. Our discussions, debates have been one of the best parts of my life for the last 10 years. Raji, great to have you.
Thank you, Gary. I really looking forward to coming on and always enjoy these discussions.
Yeah, well, this is for everyone who's listening. This discussion is pretty much what Raji and I do on a daily basis, and we thought it might be helpful to bring everyone in. So, Raji, the title of this one, all the news is bad, but the market keeps going up. I got an interesting comment on Twitter over the weekend where someone said, well, of course the news is bad. The media just reports the negative. And I thought that was a really interesting, astute observation. But I also think that the news is actually bad. We have huge inflation numbers, declining GDP. The Fed is going to have to raise interest rates more than anybody had expected just a few months ago. We've got war. That war is going to create huge problems with the food supply, with oil supply. There are supply chain issues still going on in the port of Long Beach, still going on in China. To me, this seems like all really bad news. I think if somebody would have said to us 2 months ago, this is what the news flow is going to look like for the next 2 months, would you have bet for an up market or a down market?
Yeah, I mean, it's the news has not only been particularly bad, but when you think about the U.S. economy, it's 68% consumption. Consumer drives a big part of our economy and a lot of economies, and all the commodity price inflation, supply chain problems, both on the commodity side and on retail goods. We've seen prices increase, and that doesn't bode well for consumption growth going forward. And historically, anytime you've had a more than 50% spike in energy and food, down the road, pain comes. So it was already bad before the Ukraine stuff started, and then the Ukraine-Russia war occurred, the invasion, and that's a whole different level of bad because I don't know how many people are aware of Ukraine's imports in the global markets, but interesting statistic: 1 in 10 loaves of bread in the world are baked with Ukrainian grain. 15% of Europe's gas supplies go through the Ukrainian pipelines into Eastern Europe. Ukraine produces 50% of neon gas in the world. Why is that important? It's an important gas in semiconductor manufacturing, and we already have a semiconductor shortage. And so when you look at all these things, it's quite bad. And then you throw in inflation numbers that are running very high already. The 6%, 7%, and then 8% numbers didn't really include the Ukraine effect. And a Fed that seemingly is committed to maybe even more than 25 basis point hikes. It's all bad, right? So why would anybody get positive? And you and I have debated this for quite some time.
Oh, sorry, your video first for a second.
Sorry.
We've been publicly out for months saying that the inflation number is understated by at least 100%. And
owner's rent is a joke, right?
What's that?
Owner's reported rent is what a joke.
Yeah, exactly. And the way we've come at it is rents are up 18 to 20%, and the U.S. Bureau of Labor Statistics is saying it's more like 4 or 5%, which is simply not correct. And then we've been seeing food inflation numbers in the neighborhood of 6%. Worldwide last year was 24%. Germany is going to experience 50% inflation. You were the one who sent me that information.
The grocery supermarkets, and they raised food prices 30 to 50% today.
Right. So if that's the case, we just ask everybody on this call, does anybody here really believe that U.S. food inflation is only 6%. Like, honestly, you guys use the chat feature. Actually, use the chat feature if you have questions. But if any of you think that food inflation in the U.S. is less than 6%, chime in. We want to hear from you. I'd be shocked if anybody's experiencing that. So,
Yeah.
Raji, what's that?
So yeah, I mean, it's kind of a if you had predicted what was going to happen, you would have said, "Wow, this is bad for the market." And for a while, you were right. I mean, the market was reacting to that news. So you and I have discussed this quite a bit, and I think I'd like to cite two facts. First of all, if you go back to 1929, right, the big crash, if you look at the actual 1929 period, there were 3 or 4 what they call bear market rallies where the market went up well in excess of 10%. But over a 3-year period, the market did quite poorly. And I think some of the problem in trying to analyze what's happening is the time frame is too compressed, right? It's a noise to signal ratio to borrow an engineering term. So these things are problematic, but we're analyzing the market action over a short period of time. The very strong substantial rallies in prior extended bear markets were not a sign that the problems were over. It was really more technical aspects to the market at those times, which we'll talk about shortly. But I just think the time frame is too short. And the other thing is, for example, the yield curve inversion or the spike in energy prices, it doesn't have an immediate impact on the economy, right? I mean, historical case studies for inverted yield curves is you get a recession, but it could be 12 to 18 months later. So, it's hard to pattern fit history today and get an exact answer. But, the signs that are developing are quite bearish. And it's not clear, there's an all clear green signal from the market. This really, we've had the Ukraine conflict started, 5 weeks ago, and we've had the crash and the recovery in 5 weeks. The war is going to extend much longer. And, even the focus on the conflict oversimplifies it. The problems that were in the commodity market and supply chain were there well before. Oil inventories are at historic lows. Things aren't getting better on commodity price inflation. So, it's just that this past month where the rally happened, I think the time frame is too compressed. And I think there's certain clues in terms of short term what's going on. And a lot of it has to do with, like you said, the news was so bad, everybody knew it was so bad. When everybody knows something, they tend to be on one side of the trade. Who wasn't short or hedged or defensive coming into this, right? And people got too far on one side. And it was kind of interesting. I think it was the 14th or 15th of, I want to say February, but it might have been March. But we had news of the Shanghai COVID shutdown, and oil went down pretty sharply, and growth stocks rallied, and particularly high beta, high growth, heavily shorted stocks have rallied. And if you kind of look at ARK investment type names, the stay-at-home teledocs, the disruptors, the high EV to sales companies without much in the way of earnings, have done the best. Those were also the most shorted sectors. So, in this short period of time, everybody got on one side of the trade. And it's unclear, whether this isn't short covering or if there's something, more substantial in terms of, more positive signs on the economy. We yet haven't seen all the impacts of inflation, right? That's still coming. I think, the next quarter's earnings will be interesting. Because we'll maybe start to see companies on guidance talk about some of these pressures. But we're kind of in this vacuum where a lot of leading indicators are red flags: commodity price inflation, Fed policy, yield curve structure. But it's not an immediate sell reaction, right? It doesn't mean next month's economy is going to be weak. But, the negative forces are there. And short term, it's probably more of a technical outcome of people being too short or too hedged or out of the market. I mean, today, right? The news hasn't gotten better, and the markets remain, started off April strong. And I think there was a Morgan Stanley report that said, funds are at their 14th decile of lowest net exposure in a decade. So, people are on the other side of this because things have been so bad, and you get these kind of covering rallies, and they're brutal and they're sharp. And we know from history, bear market rallies are substantial. So yeah, it is confusing. It doesn't really mean anything, right? Short term, it's more a function of kind of where exposures are across funds and sort of trading noise. But long term, it's quite worrisome. If you go back to historical periods, every time markets kind of rebound during these particularly ugly periods, there's always the same question: how can people be optimistic when things are trending so bad? And quite often, the time frame is too compressed to really get the signal. You're more focused on noise.
So it sounds like what you're saying is the news really is bad. You sound actually pretty bearish, like we are, in terms of the fundamentals, and are saying that a large part of the recent rise in the indexes is related to just people getting out ahead of these bad fundamentals too quickly, and then short-term trading dynamics, and then the fact that we're not really looking through a whole cycle. We're looking at a few weeks, which isn't really indicative of anything.
There's a saying: buy on the rumors and sell on the news. Well, it works on the short side too, right? And I thought it was interesting. I think for us, we actually removed our hedges, as really around the PPI report date and the Fed rate hike date. Neither one of those was great news for the market, and both days the market rallied. And that was a tell. Near term, we were getting the bad news. The market should have broke on that. It wasn't breaking, and it was then you looked at kind of the action and the high beta growth stuff, that gave us some indication that it was really an exposure problem, and we want to get out of the way of that. But yeah, we'll have to see. I mean, people are pattern fitting history right now. They look at prior periods where we've had these kind of commodity price movements and dynamics in the interest rate and credit markets, and the forward outlook hasn't historically been that great, right? It's led to problems, but we know there's this delay period. So I think we're starting to see cracks, and our expectation is as the year unfolds, we're going to see more problems. But the ultimate tell will be the results and what happens. I mean, we're expecting bad news, we're looking for it, and we want to see the markets react to it. I don't think that'll change. I think the near-term stuff is more trading noise.
Yeah, and regarding corporate earnings, when you're talking about companies starting to address inflation concerns, I think that's something we started to see last quarter, where some of these companies would come out and they'd say, we've taken inflation-related price increases and haven't been able to increase prices fast enough, right? They actually said they increased prices and their costs went up more.
Yeah, it's kind of interesting, right? You look at corporate operating margins, and they came out of last year at historic highs in relation to GDP, and they're way above trend line. What does that look like in reverse, right? When those start to compress, and we're starting to see companies capitulate on this. Companies held back on price increases. Right, they took the hit on margin for a bit to kind of, nobody really understood how long this was going to go. If it was going to get worse, supply chain was going to get better in the first quarter. They were going to fix it, and the commodity stuff would cool off, and it got worse. Obviously, Ukraine was part of a catalyst to that, but you're starting to see people raise pricing more aggressively across the companies that we follow, at least in the consumer space. In tech, it's a bit different, but. This is an unfolding story, right? And the problem is a lot of times people look at a static view of the world and they say, okay, this bad stuff has happened. It's not so bad today. But you and I know it's a vector, right? Things won't be better the things are getting worse. So today's not the bottom in terms of fundamentals or economic health. We're trending somewhere that we think is negative. And, it's, any analysis you do that extrapolates recent results is going to be wrong. And we saw in a lot of companies, especially in the tech stuff, bad quarters, slowdowns, lower spending. That's typically not a 1 quarter phenomenon. And so when the consumer gets hit, it's not a 1 quarter phenomenon. So, there's huge potential for bad news in the second half of this year. And I think that's why a lot of funds have stayed defensive. They've kind of ignored the recent volatility and especially the rally, because who wants to be in front of next quarter's guidance? I mean, look, if you're a company, look at Restoration Hardware, look at a whole host of other companies. If you're management, macroeconomic uncertainty is really, for these guys, the best opportunity to take down numbers, right? They get to issue new options to themselves at lower prices, and it's kind of, they game the system, and nobody blames them for having company-specific management problems. It's macro, so we'll take down the numbers, lower the bar in a period where nobody will blame us specifically. And so, that's coming. We'll see what happens. I think, this quarter's earnings and guidance, people have to pay particular attention to. And, it seems to me like there's incentive for managements to lower, if not moderate, expectations going forward.
So I think that's a great point. I'd file that under things that you're looking for that maybe the market in general isn't thinking about. For us, the thing that we're looking at, that we think the market is missing, is regarding the rate hikes. So right now, the expectation is that the Fed gets to about 2.5% this year. They do 6-7 rate hikes, maybe another 4 next year. And there's this expectation that inflation will moderate. And our view is that's, first of all, nobody could know that. But beyond that, that's completely crazy.
Is quite ugly on that. I mean,
yeah,
right. In order for the Fed to correct a supply chain or supply shock, look at what Volcker had to do in the 70s. I mean, they had to push up short-term rates to, what was it?
15.3%.
Monetary policy doesn't address the problems going on in all these commodity markets. Underinvestment by companies, drought, fertilizer prices up. Russia's 14-15% of the fertilizer market.
And a bigger part when it comes to exports.
And for monetary policy to really bring that down, there's a long way to go, right? And they have to be very aggressive. So I also think there are maybe 3 other things that will make it hard for Powell to raise rates in the way that Volcker did. One of them is Volcker at least was working off of relatively accurate information, but Powell's working off a CPI that's understating the number by 100%, right? And we talked about that earlier. So the numbers that he's looking at and the numbers that they have to talk about don't reflect the real economy. The second more key thing here is Volcker was able to do this. I think U.S. debt at the time was less than $1 trillion. Yeah. And so when he went to 15.3%, you could do that, right? But how now we're at over $30 trillion, and that's just on balance sheet. So you tell me what happens when we get out past 3-4% on borrowing. It's funny because you and I always discuss how the only way you get governments to become disciplined on spending
is the bond market,
right? You saw that in Europe when Greece imploded, and all of a sudden Italy and France were looking at 5 or 6% interest. That's a very sort of come to reality moment for these countries. And there's certainly that problem here.
And then I'd add one more issue that Powell has to deal with, which is, I think if you go back 40 years, the Fed was, right or wrong, really viewed as an independent institution. And for a variety of reasons, the Fed is now a political institution. And Volcker was in a position where he could throw the U.S. into recession and just say, this is what we need to do. But what happens to Powell when he gets to 2.5-3%? The economy is already contracting because, remember, the GDP numbers aren't inflation adjusted. So we think inflation's already, GDP's already gone negative.
Real wages
and so
negative.
Right. And so what happens? He gets to 2.5%. That doesn't cure inflation. And we still have negative GDP. At that point, we're in stagflation. And you tell me how in the world Powell is going to keep raising rates when we're in stagflation. He doesn't have the political rope and freedom that Volcker had 40 years ago. Or am I seeing this wrong? What do you think?
Listen, you're spot on. If there's any evidence, the historical evidence is the Fed panics every time the market goes down 20%, and kind of, it's like having a junkie stuck on drugs, right? It's hard to get them off drugs because they go into a very difficult period to recuperate. So, he's stuck. I mean, irrespective of what the Fed does, there's a lot of negative headwinds facing the market and the economy, right? Either he raises rates enough to slow things down and crush the economy, or he doesn't do it enough, and negative real wages and pricing and income destruction, real income destruction, is going to do it for him, right? You can't ignore the disparity between what wage growth is and inflation and where that may go. So yeah, this is a very difficult macro market, right? It's a very hard thing to see and figure out, and there's a lot of noise around it. I mean, can inflation be transitory? Does that disappear? Do we see supply chain magically improve? Do used car sales, which were a big driver last year, a third of the inflation CPI, reported CPI at least, does that improve? It's hard to know. I mean, we just had a near 10% PPI number. And CPI was 8%. PPI is the leading indicator. I mean, April is looking to come in pretty hot in terms of inflation. So, ironically, the Fed may be raising rates aggressively into a slowing economy in the second half. Not a great, recipe for things.
Yeah, I think they are. Beyond that, I think you just had the line of the day. Essentially, we're going to have demand destruction because the Fed raises rates, or the Fed doesn't raise rates and we have demand destruction because of inflation.
Yeah, it's one of those great lose-lose situations, right?
I think that's where we are. Let me shift the topic. Go ahead.
Absolutely.
No, go ahead. Finish your point, though.
So yeah, look, it's a challenging environment. I mean, you have leading indicators that historically are major red flags, and I think anybody who pays short-term attention to what the market's doing is going to get whipped around. It's and you have to kind of look at it in terms of where the panic points occur. The panic points will be around Fed policy, around the inflation reports, and around guidance next quarter. This has been an incredibly resilient market, right? It recovered from COVID quickly. It recovered from the spike in rates last year early on. But again, 2008, right? We had the end of the year mortgage collapse. 2007 is when Bear Stearns went, right? Belly up, wasn't that the time frame? So it was a year later.
Yeah.
So you and I have been in the markets long enough to know the cracks form, and then the whole thing falls apart. And there's a lot of cracks right now. So people might be looking past that. I don't, I'm not sure where that confidence is. I don't see where the inflation outlook gets better, and certainly where the Fed's inability. The Fed can't lower rates from where they are. I mean, there's not that much room. So, this is a very difficult macro market. And as a macro market, it's challenging because it's not about the companies.
Yeah. So let me change the subject for a minute. I want to bring up a debate that you and I were having at the end of last week. And we were talking about currency. We're talking about the US dollar. And you pointed out that the dollar has actually strengthened through all of this. And my response on that is it has versus other fiat currencies, but it hasn't versus Bitcoin, gold, corn, wheat, silver.
Horrible in dollar terms.
Right. But not just so basically it's the dollar has done well versus other fiat currencies, but all that's telling you is it takes more and more fiat currency, no matter where you are, to buy anything that matters, to buy raw materials, to buy commodities, to buy the things that you need to live, to buy anything that would resemble stable money.
Yeah.
Right.
Yeah.
So the argument I would make is regardless of where the dollar is trading versus other currencies, and I think that's what people are looking at, I actually think the dollar is weaker. because you can't buy as much with it.
The purchasing power of the dollar is weaker. The nominal value has gone up. To add to your point, which is really spot on. I mean, people are also accepting very negative real rates on what are risk-free assets like the 10, 30-year Treasury. That's a more complicated market, right? People view the U.S. as tightening first, and that higher rates strengthen the currency, right? A tighter monetary policy typically leads to a stronger dollar, and then you've got international flows out of countries that have no rates, and are not, Europe, Japan. So it's a more complicated equation, but yeah, nobody wants to be in dollars during an inflation spike. I mean, that's why you're seeing all these hard assets do so well. Bitcoin as well, the digital stuff. And the digital stuff is interesting because now, with the moves against the Russian central bank, and the banking system, the SWIFT sanctions, that's all based on the dollar being the reserve currency of the world. That our ability to, impose these sanctions and these actions are because everybody uses the dollar as a reserve currency. That's a whole different topic, right? But yeah, look, the dollar is you don't want to be in the dollar. You want to be in stocks that are commodity based or have pricing power during a period of high inflation. You don't want to be in, bonds at 1%, 2%, or cash.
So you actually just gave a sneak preview of next week's newspaper article that we've got in edit right now.
Oh, sorry.
And what we're writing about right now is the effect of the sanctions on the U.S. dollar as the world's reserve currency.
Well, and this debate, right?
Yeah,
a lot, because if you lose the reserve currency, people don't appreciate that's like owning King Midas's mine, right? That's like being given the power to turn lead to gold, right? That's
paper to gold.
Right. So, the U.S. would pay a much higher rate of borrowing if people around the world didn't have to own dollar assets, and our ability to influence geopolitics would also be greatly reduced. So, yeah, I mean, losing anything that chips away at the reserve currency status is an issue. The debates, I think, always, and you and I have had some interesting debates, is what's the alternative? Nobody trusts the euro to stay together. I mean, right? The whole Brexit.
Right. Yeah.
European mismanagement, slow growth. People talk about the end of the EU during Greece, right?
Right.
The Northern European countries were subsidizing Southern country spending, and why should they do that? And they got a stable currency, but they had there's a lot of problems with the euro, and it was supposed to be a replacement for the dollar or an alternative. That I'm not sure they have that, and I know China wants to throw its hat into doing that, but they've got who trust the Chinese government as the keepers of the reserve currency. I guess who trusts any central bank with that question. But yeah, that's a big issue, right?
You know my position on that, which is all fiat currencies go to zero over time. So
well, I think the interesting stat that you always tell me, which I always find fascinating history, is like since the inception, they've all lost like 98. Like the good ones lost 98% of their value, and the bad ones lost 99% of their value. Right? That's it's being in fiat currency is a bad bad place to preserve real value in these things over extended period.
Right. Well, so there have been somewhere in the neighborhood of 800 fiat currencies that people have been able to track throughout history. They've all gone to zero with the exception of, the ones that we have currently standing. The average age for a fiat currency before failure is 27 years, which is crazy. It's a generation and a half. And the world's two oldest standing fiat currencies are the British pound at 300 some years, which has lost 99.5% of its value, and the US dollar at a little over 200 years, 250 years, which has lost 96% of its value since 1800. Right. Yeah. And by the way, those were your two best bets. Everything else went to zero.
Went to zero. Right. That's
right.
So of your money, that's the win.
Yeah. And so like the preview of next week's newspaper article for us is, look, I think the sanctions are well-meaning. I think there's something to be said for trying to put pressure on Vladimir Putin for making it difficult for him to continue to prosecute a war that should be exited immediately. Um, this is one of those few situations where I don't necessarily see bad intentions in the minds of the politicians involved. But I think the thing that people don't realize is that the sanctions that they've put in place regarding oil, the SWIFT system, impounding dollar-based reserves, these will all have the perverse impact of reducing the value and trust in the dollar as the world's reserve currency. And so I think the White House should be honest with the American people and say, listen, these things that we're doing are going to cost you a fortune. We need to decide together how much we're willing to pay to protect the freedom of the people of Ukraine. And, should we do something to protect them? Yeah, absolutely. But the country should be informed on what this is going to cost us. And I don't think there are very many people in Washington who are aware of that, who understand the way that their actions are threatening the value of the dollar as the reserve currency.
Look, I think you're right that, seizing any central bank assets and SWIFT sanctions highlight, that if you're in a dollar-based system, you're subject to, the countries that run it, the regulations and that legal framework. I think I'm sure we disagree, or, where I'm less sure is there are many things over the last 10, 20 years to raise concern about the status of the reserve currency, the dollar, right? Growing national debt, deficit spending, political instability. I always come back to, without a viable alternative, the U.S. has the benefit of being the world's largest economy, right? And there's so much, it's a liquid market. What would be the replacement? You're not going to replace the dollar with hard assets like gold or silver. Certainly, I don't think the Chinese yuan has any shot at, not maybe over 20, 25 years. Euro, maybe, but that didn't really work and hasn't worked so far. Maybe crypto, but it's hard to know. Like, you're talking about trillions of dollars that have to find a place that's liquid with some stability. So, yeah, it's a problem. I don't see where the alternative is for quite some time. And I know a lot of countries are working on alternatives to SWIFT, like the Chinese. I know countries are, like Iran and Russia now want to be paid in ruble for oil and energy. So it's something to monitor, but, and that's what we're doing. But, it was fascinating the way the U.S. was able to go after the central bank assets and on the SWIFT system, and it highlights the risk of people running on those systems.
Right. And that's exactly the point. I think that those actions were well-meaning, but may end up coming back to bite us in the butt. And Neil from Connecticut actually just chimed in with his answer on this. He thinks the answer on what becomes the world's reserve currency if the dollar fails, if the euro fails, is crypto or Bitcoin. And he's citing analysis that basically says it is a liquid market. And so the issue with gold is you require physical delivery and you need a lot of it. And it's large and heavy and needs to be secured. Where Bitcoin, as an example, can be divided and subdivided into tiny fractions. You can buy a coffee with Bitcoin. You just use a fraction of it. And he's pointing out that if all fiat goes to zero, the report he was reading looked at gold and Bitcoin as reserves. And then some other people who follow crypto very closely might argue that Bitcoin with the, versus proof of work versus proof of stake might not be the way to go. And you could end up with Ethereum, but you really could end up with a non-governmental, non-fiat solution to that. And that would be really interesting because what you do is, and this is something you and I have debated for years, that would remove the problem, which I would like to see solved which is the influence of central banks on everything that's happening. Because I think they've blown up huge asset bubbles and they've created a gigantic problem that's coming.
Well, I'm a big fan of the Austrian School of Economics, so I agree that central banks often are an agent of evil. But I'm also not a crypto expert, so just full disclosure, it's certainly an interesting topic, and I can see the blockchain technology separate. That's going to be a big thing, clearly, especially in disrupting and making a number of industries more efficient, like payment processing and a host of others. I guess the question with Bitcoin is it's fixed. It's a fixed money supply, basically, right?
It's deflationary.
Right. So what happens in a country where the money supply doesn't increase? If that becomes, I'm not sure how to think about that, but, it's kind of like going back maybe to the gold standard to some extent, right?
Yes, it is.
It's a Bitcoin standard and yeah. Velocity of money and economic growth. And, that's above my pay grade. So crypto has got probably the best shot, that or the euro. I think the euro today is not. Look, maybe the answer is countries diversify, but the reserve currency thing is where do you transact most of your business? You're going to write contracts for oil and grain in Bitcoin to be paid in Bitcoin. That would be interesting.
Why not?
Well,
why not?
You couldn't, but there's a lot of volatility. Bitcoin's much more volatile than the dollar, near term, short term, right?
Okay, so it is, but that
becomes a problem.
That doesn't mean the value is going down.
No, but even over like a year period, you can have 50, 60, 70% moves in Bitcoin, right? Relative to the dollar or relative to other exchanges. So there's a lot of volatility. That would change if Bitcoin, if crypto gets used in more transactions. But, again, I'm not an expert, but the questions I'd have, I think, crypto is definitely a possibility in terms of taking some share away from the dollar, and that would be interesting to develop. But again, it's not my area. The questions I'd have is the volatility of Bitcoin and the security of it. How unhackable is it? I read articles about this stuff. It's just not my area. But yeah, look, the world wants something other than the dollar.
Right. Well, I'll give you the short answer and the long answer. The short answer on your question is the way you end up with enough money supply, with enough money velocity, is the value of each coin goes up, right? There's no limit. That volatility has unlimited upward potential. The way you deal with it in terms of contracts and purchases is it can be divided and subdivided and subdivided.
Right, you do fractional Bitcoins and things.
Yeah, exactly. Right. You can give Bitcoin for a couple of pennies if you wanted to. The long answer, we'll have to wait till next week. A special thank you to the guys at TradeZing who just got me a very expensive ticket to join them for the Bitcoin 2022 conference. I'm joining them in Miami in 2 days. And so hopefully by this time next week, I will know more about the topic and we'll have the long answer then.
Yeah, no, look, it's fascinating. I think, the dollar status as reserve currency is something that has to be watched. And I think people take it for granted and don't fully understand how catastrophic it would be if the world moves away from that. Crypto is definitely recently, one of the better arguments, I would say, versus the Chinese currency or, the euro today, right? But it's something that needs to be monitored.
Yeah, the other thing I really like about crypto is it solves the social credit problem. You can take a look at the fact that the US just froze Russian reserves in dollars. Now, did we have a good reason? Sure, but we still stole their money because we didn't like what they were doing. You and I would
debate that, but that's not my view, but I understand that interpretation.
Yeah. A more extreme version is what just happened in Canada, where the government froze the bank accounts of the Canadian truckers, essentially saying, we don't like your protest. And I see these things as potential enormous problems where the government says we're not comfortable with the speech you're exercising. Or now, I don't view Putin's invading Ukraine as free speech or a valid political protest, but any digital currency system is going to run into the same social credit issues that China has, where they tell you if you're a good citizen or not,
Well,
if
I
they're
mean, in all
happy with you or
fair,
not.
you know, look, if you transact in a currency of a country, you're subject to that country's. I mean, that's
Right.
if you're in their system, that's part of it. I don't, you know, I haven't thought about it in the terms that you have in terms of some of the political discussion, but you know, anybody who owns dollar assets and those run through the SWIFT or the U.S. banking system, those are subject to seizure. You know, that's the benefit of Bitcoin. But you know, it'll be interesting to follow. You know, just from our perspective, it's not our area, and you know, and we don't think it's near term a big enough problem to see a major move away from the dollar today. And in every period of stress, we see money run into dollar assets. So it'll be interesting to see how that develops over time.
Yeah. Okay. All right. So Raji, we're running short on time.
Sure.
Want to get your last word on one thing. For us, we've told people the stuff we're using to hedge against all of these issues are gold, silver, Bitcoin, oil, and market hedges, right? Shorting indexes, which is a pretty substantial list. Anything you'd want to add to that list? What else should people be thinking about to protect themselves? Like you and I have just spent 40 minutes talking about how bad reality is. It's not just the news that's bad, it's reality that's a problem here. What else would you advise people to do?
Well, I think that's right. I mean, I think, if, we have to figure, what's the right historical economic case study? Is it the 70s, extended period of stagflation? Is it a different period? But, as you've said, I mean, today and most recently, that's what we've done. We've used hard assets. Our focus has been on energy stocks, and we've had an outsized weighting in those stocks since last year, which is unusual, right? Because we're typically growth guys. So all of a sudden we're studying, petrochemical companies and, energy economics. But, that applies to food, ag, metals, gold, precious metals, Bitcoin. For us, what we've done is we've increased our exposure to oil, energy, and then we've used market hedges pretty aggressively and then traded around those. So running a low net exposure with, a fair amount of the long exposure in energy. And then, avoiding consumer stocks, things where there's the consumer exposure, right. Avoiding companies that don't make money, right? No pricing power. If you're, if you're, a high growth tech company or another company, that's growing revenue quickly but losing money, it's hard to raise prices, another commodity, but the commodity, you have to be careful, right? Because all the commodity businesses are doing well, but there are a lot of commodity-like businesses, where they have no brand, there's no moat to the business. Those you have to be careful for, because really what you have is costs are going up, right? So which companies have exposure to those costs going up, and which ones can raise pricing? Restaurant is problematic, right? Their costs are going to go up, and we'll see how much they can raise pricing by. If you look at like a Google or a tech company, they don't consume grain or oil in producing their product. So different businesses and industries have different exposures to the commodity, the spectrum of commodities directly, and then some are more exposed to consumer. Some businesses have maybe a recurring model, revenue, subscription-based model in media, streaming, those kind of things. But that's kind of how we've thought about it, right? We don't want to be in the stuff that's very consumer oriented, retail, discretionary products, to be careful. But there's many other ways to do it. What we've done is a low net exposure and a heavy energy on the long side.
Got it. All right. So as we wrap up here, the thing that I want to convey to the people who are watching this video is as much as we see a very challenging environment ahead, that doesn't mean there aren't opportunities to make money. The ways that Raji and I are talking about hedging our portfolio aren't just ways to protect your portfolio, they're ways to make money out of a bad environment. And if you're smart and nimble and forward thinking, there are always opportunities to actually earn profits instead of just maybe lose a little bit less. For those of you who are interested in how deep knowledge investing can help you with that, we recommend that you go to our website, deepknowledgeinvesting.com. There's a subscription button. Feel free to click that, subscribe, check us out, and we'd be happy to help you with these things. For those of you who are as fascinated by what Raji has to say as I am, because like I said, I talk to him on a daily basis. As I said before, he is one of the best stock analysts and smartest portfolio managers I've ever known. He's running a firm called ArcanX. And if you are interested and want to learn more, reach out to me at ir@deepknowledgeinvesting.com. I will put you directly in touch with Raji, and you can hear more about his fund privately. So
thank you,
wrap
I
here.
enjoyed this.
Yeah,
feels like
Raji,
another day talking with you. I appreciate it.
This is like, we don't need to talk later this evening. We've covered everything.
Yep.
All right. Raji, thanks so much for doing this. Such a great pleasure. Everyone, thanks for listening in.
Just one last thing. Sorry.
Yeah. Go ahead. No. Please go ahead.
You and I always, one of the things that we always remind each other is it's okay to say, I don't know. Right. So people always ask questions about what's going on. And, often the answer is, I don't know. Let's see where what the data shows us. Right.
Right.
And, I think that's important to remember. It's not the data that we need to process to make decisions like that. It's still in the future, and we need to just make sure we're monitoring that.
Yes, that's a great point. And you know what? A simple way of relaying that to everyone here is stay in touch, because as the data comes in, both Raji and I reserve the right to change our opinion on the circumstances, the economy, the direction of interest rates, and what we think about the market and where we're invested. As new data comes in, we'll change our minds and change our positions.
Perfect.
All right. Raji, thanks again.
Yeah, I enjoyed it. Have a great day.
Talk to you.